A company borrows $5 million to build a new factory. The factory generates returns over 15 years, but the loan repayable in 18 months. On paper, the deal looks fine on day one. By month 19, with no lump sum to cover the repayment and the factory only partway through its earning life, the company is in serious trouble. Not because it borrowed too much, because it borrowed it wrong. Every financing decision a company makes has to satisfy two basic principles. Principle 1, matching. The life of the finance must broadly match the life of what it funds. Long-lived assets, buildings, machinery, major systems need long-term finance. Temporary cash gaps, a seasonal stock build, a short bridge are for short-term finance only. Get this wrong and the mismatch itself becomes the risk. Principle 2, risk and return. Someone always bears the risk of a financing arrangement. The higher the risk they're asked to take, the higher the return they'll demand in exchange. These two principles cut through every finance decision. Now, let's look at what the actual sources are. Long-term finance is what most companies are built on. Three main types: ordinary shares, preference shares, and bonds. Ordinary shares. The most common form of long-term finance. Ordinary shareholders are the owners of the business. They receive dividends and vote at AGMs. They also take on the highest risk of all investors. No guaranteed dividend, no guaranteed sale price, and in a liquidation, last in line. Every creditor, every bondholder, every preference shareholder gets paid in full before ordinary shareholders see a penny. In return, the highest possible upside. Ordinary shareholders are the sole beneficiaries of all retained profit growth and all share price appreciation. High risk, high ceiling. A company can issue ordinary shares in 5 ways: offer for sale to the public, offer for subscription, a placing to selected private investors, a rights issue to existing shareholders in proportion to their current holdings, or crowdfunding. Key advantages: no obligation to pay dividends and the capital is permanent, it never has to be repaid. Key disadvantages: expensive to issue, dilutes existing shareholders' control, and dividends aren't tax deductible the way interest payments are. Preference shares sit between debt and equity. Fixed dividend, paid before ordinary shareholders, but no voting rights, so they don't dilute control. They can be cumulative. Missed dividends roll forward and must be cleared before ordinary dividends can be paid. Convertible, switch to ordinary shares later. Or redeemable, bought back at a set date. Useful when a company wants to raise capital without giving away a vote. Bonds, also called debentures or loan stock, all used interchangeably here. A bond is borrowing without going through a bank. The company pays interest, fixed rate or floating, set at a margin over a benchmark rate, and must pay it whether or not the company is profitable. Interest on bonds is tax deductible, making debt cheaper after tax than equity. Here's what most introductory courses skip: bond credit ratings. Agencies like Standard & Poor's assess a company's creditworthiness and give its bonds a letter grade. AAA is highest. The company is seen as extremely likely to pay. Below investment grade, sometimes called junk, means significantly higher default risk. The lower the rating, the higher the interest rate the company must offer to attract investors. A rating downgrade isn't just an embarrassment, it directly increases borrowing costs. A company that slips from BBB to BB might see its cost of debt jump by hundreds of basis points overnight. Before we move to medium-term finance, here's how all 3 long-term sources compare on risk and return. Government bonds sit at the bottom. Low risk, lower return. Corporate bonds above them. Preference shares above that. Ordinary shares at the top. Highest risk, highest potential return. This ladder is fundamental. It drives investor pricing, it drives how companies structure their capital, and it's the framework behind every decision in modules 10 and 11. Medium-term finance typically covers a few years. 4 main types. Term loans. Bank loans with a fixed repayment schedule, not necessarily equal installments. The schedule can be designed around the cash flows the funded asset is expected to generate. Some loans have a bullet structure. a single large repayment at the end. Banks attach covenants to these loans: maximum gearing, minimum interest cover, regular reporting requirements. Breach a covenant, and the bank can demand immediate full repayment of the entire outstanding balance. Hire purchase. A finance company buys the asset, the borrowing company uses it, pays fixed installments, and takes legal ownership at the very end. If you've ever financed a car, you've done hire purchase. Exact same structure. Lease contracts. Similar to hire purchase, but legal ownership may never transfer. Under IFRS 16, most leases are recognized on the balance sheet, a right-of-use asset and a corresponding lease liability, so they affect reported gearing even without a formal loan agreement. Interest payments are tax-deductible. Venture capital and business angels both invest in high-risk, early-stage or growing businesses in exchange for equity, typically for 3 to 5 years before they exit. The key difference: venture capital firms are institutional. They'll often insist on placing a member of their team on the board of the company to monitor the investment. Business angels are wealthy individuals who usually bring sector expertise alongside their money and are often willing to back a business at an even earlier stage than formal VCs. Short-term finance covers temporary needs only. Seasonal working capital spikes, bridging gaps, short-term cash crunches, overdraft, an agreed limit on a current account, interest only on the amount drawn, flexible and cheap for genuinely short-term needs. But here's the hidden risk: overdrafts are repayable on demand. The bank can call the facility at any time for any reason. A company that relies on an overdraft to fund ongoing operations is violating the matching principle and leaving itself dangerously exposed. Factoring. A company sells its trade invoices to a factor, a specialist firm. The factor advances roughly 80% of the invoice value immediately in cash. The remaining 20%, minus the factoring fee, arrives once the debtor actually pays. The factor can also run the entire debtor's ledger, chasing invoices, recording credit sales, applying credit pressure, for a fee of around 2% of revenue. And it can provide credit insurance against bad debts. FinTech firms now offer the same service online, with cash sometimes arriving within hours of an invoice being raised. 2 more worth knowing. Government grants. Free money, no repayment required if conditions are met, particularly for job-creating investments. And rewards-based crowdfunding. Investors fund a project without taking an equity stake, often receiving a product or service in return. Every company needs finance. The skill is choosing the right type, at the right time, matched to the right purpose. Long assets need long money, short gaps need short money. And the riskier the instrument, the higher the return investors will demand. Module 3 goes into the legal mechanics. Exactly what rights shares and bonds carry under UK company law. Subscribe and I'll see you there.